Michael Burry, full name Michael James Burry, is an American investor, hedge fund manager, and physician. He gained significant attention for his accurate predictions about the housing market collapse in the mid-2000s, which was documented in the book, The Big Short, by Michael Lewis and later turned into a successful film. Burry's successful bet against the subprime mortgage market helped him and his investors make substantial profits. Burry was born on June 19, 1971, in San Jose, California. He attended the University of California, Los Angeles, UCLA, where he studied economics and graduated with a Bachelor of Science in 1995. Later, he earned his medical degree from the Vanderbilt University School of Medicine in 2000. Despite being a licensed physician, Burry decided to pursue a career in finance rather than practicing medicine. In 2000, Burry founded Scion Capital, a private investment partnership, with a focus on value investing. He had a contrarian approach and was known for conducting extensive research on companies before making investment decisions. His expertise in analyzing financial markets and identifying undervalued assets led him to foresee the impending subprime mortgage crisis. Burry extensively researched and analyzed the subprime mortgage market. The subprime mortgage market refers to the segment of the mortgage industry that caters to borrowers with less than ideal creditworthiness. Subprime borrowers typically have lower credit scores, higher levels of debt, or a history of late payments or defaults. Due to their perceived higher risk, lenders charge higher interest rates to compensate for the increased probability of default. During the early to mid-2000s, the subprime mortgage market experienced significant growth in the United States. There were several factors that contributed to this expansion. Financial innovation. Financial institutions developed new mortgage products to attract subprime borrowers, such as adjustable-rate mortgages, ARMs, and interest-only mortgages. These products initially offered low introductory interest rates, making them appear affordable to borrowers. However, these rates were often reset to higher levels after an initial period, leading to increased monthly payments. Securitization. Mortgage lenders packaged groups of mortgages into mortgage-backed securities, MBS, and sold them to investors. This process, known as securitization, allowed lenders to transfer the risk associated with the loans while generating immediate cash flow to issue more loans. Easy access to credit. Lenders relaxed their lending standards and offered mortgages with little or no down payments, reduced documentation requirements, and lower credit score thresholds. This led to a surge in mortgage originations, including subprime loans. Housing boom. The housing market experienced a significant upswing, with rapidly rising home prices. This created a perception that housing values would continue to appreciate, making it easier for borrowers to refinance or sell their homes if they encountered financial difficulties. However, several inherent problems within the subprime mortgage market eventually led to its collapse. Housing market downturn. As the housing market peaked and began to decline, home prices fell, leading to a decrease in the value of mortgage collateral. Borrowers who had taken out adjustable-rate mortgages faced higher monthly payments when their rates reset, often resulting in payment delinquencies or defaults. Loan defaults and foreclosures. Many subprime borrowers were unable to meet their mortgage obligations, leading to a surge in loan defaults and foreclosures. This, in turn, caused a decline in the value of mortgage-backed securities and financial losses for investors who held them. Systemic risk. The widespread securitization of subprime mortgages meant that the risks associated with these loans were spread across the financial system. As defaults and foreclosures increased, financial institutions that held mortgage-backed securities experienced significant losses, leading to a crisis of confidence in the banking sector. Global financial crisis. The subprime mortgage crisis, coupled with complex financial instruments tied to mortgage-backed securities, triggered a broader financial crisis in 2007–2008. It resulted in the failure or near collapse of major financial institutions, severe market volatility, and a worldwide economic downturn. The subprime mortgage market and the subsequent crisis highlighted the dangers of excessive risk-taking, lax lending standards, and the interconnections between different sectors of the financial system. Regulatory reforms and increased oversight were implemented in response to the crisis to prevent similar events from occurring in the future. He believed that the housing market was overvalued and that the widespread issuance of subprime mortgages would lead to defaults, triggering a financial crisis. Burry began purchasing credit default swaps, CDs, on mortgage-backed securities, essentially betting against the market and profiting from its collapse. Burry and his investors made substantial profits, with Cyan Capital reportedly earning over $720 million during that period. His foresight turned out to be accurate, as the housing market collapsed in 2007–2008, leading to the global financial crisis. After the success of his bet against the housing market, Burry continued to manage Cyan Capital for a few more years. However, he closed the fund to focus on his personal investments and private research. He became more reclusive and less active in the public eye. He has been vocal about his skepticism regarding the valuation of certain technology companies and has warned about the potential risks of a market downturn. It's worth noting that while Michael Burry's insights and predictions have earned him widespread recognition, it's always important to conduct independent research and analysis before making any investment decisions. Markets are complex and unpredictable, and even experienced investors can experience losses. In recent years, Burry has expressed concerns about the excessive speculation and potential bubbles in various markets, including the stock market and cryptocurrencies.